Telstra's half-year profit announced this week was down 34% to $743 million. But this doesn't tell the whole story. Underlying earnings a share jumped 55%, but still that wasn't enough to cover an 8-cent interim dividend. The trick now is to get Telstra to grow faster. I caught up this week with its chief executive, Andy Penn.
Well, Ross, as you probably recall, one of the unique dynamics that Telstra has been dealing with over the last period of time is, of course, the impact of the transition to the NBN. And so the current financial year for us is a very important one. It's an inflection because what you're seeing is the final transitional effects of the NBN in our reported results, but the growth in our underlying results from all of our initiatives under our T22 strategy. So, for example, the one-off payments that we've been receiving from the NBN are down $450 million in this half compared to the prior half. The funding or the income that we get for commercial works for helping to build the NBN, that's down $200 million. But as that washes through, what you can see is our underlying momentum. So, as you say, EBITDA was up 5.1%, earnings per share on an underlying basis was up 55%. So that's really encouraging. And as we move into FY23, those transitional effects will have gone and we can see all of that nice growth coming through.
Okay, so let's go to that though. The underlying earnings per share comes in at just over 6 cents a share, but the dividend you've paid is 8 cents a share. So in other words, in my mind, for that earnings per share to be sustainable or the dividend to be sustainable, you've got to drive this earnings per share growth much higher. Otherwise, you're going to be using your own reserves to pay out the shareholders' dividends.
You're absolutely spot on. And our dividend at the moment, which is 8 cents per share, as you rightly point out, is also supported by a special component and an ordinary component. And that special component is attributable to those one-off payments, which, as I mentioned, are coming down, and they will more or less be sort of completed by the end of this year. So what's important is we come out of this year with line of sight to that growing EPS, which our ambition is for high teens growth over the period to FY25, so that we hit that 8 cents per share underlying EPS and growing from there, which then supports the dividend, as you say. And the other point I would make as well is that we're actually generating free cash flow well ahead of our underlying net PAT as we become much more efficient on our CapEx side, and our depreciation is actually lagging, if you like, the CapEx decline. And so we're in a strong free cash flow position. We can see our line of sight to growing EPS. And so we're feeling very confident about our growth in the future.
Okay, so with that ambition of trying to grow the earnings per share in the high teens, which parts of your business now are growing fast enough to be able to, sort of fulfil those ambitions?
Well, the stellar performance in this half was absolutely our mobiles business, which of course is also our biggest business. The underlying ARPU was up 5%. Services revenue was up 6%. And our half-year on half-year growth in EBITDA from our mobiles business was up just under $400 million. So you could see that's a very, very strong performance, and we see that continuing. As we see that continue into the future, that's going to be a strong driver. But also some of the new things that we're doing with the investment in the infrastructure that you and I spoke about literally just 2 or 3 weeks ago. Our international business is going well. Our health business will deliver 37%, or did deliver 37% growth, including acquisitions, and in high teens for the full year. So there's a lot of good news coming through. And of course, as we move out from what I call under the shadow of those NBN headwinds, that's where we see our underlying growth, or our underlying results rather, start to come much more in line with their reported results.
Let's go back to that mobile business, because ARPU, the average revenue per user, is growing, which means that your customers are spending more on their mobile services on an ongoing basis. And there's also the second part about this is with the 5G rollout, you're actually grabbing market share from your competitors. But clearly that is something which, gets to a point where you can't grow it anymore. Where do you get to that point? Because it's either A, that your competitors take that market share, or B, your customers get to a point where they don't pay more or are unwilling to pay more for those services.
Well, we've got to continue to add services on top of just the pure connectivity which we're doing. But to your point, we have 2.8 million connected 5G devices on our network at the moment, and we probably have somewhere around about 10 million consumer customers or consumer services. So we've got a great opportunity to get more customers onto our 5G network. For our customers, our 5G network is only available on our top 3 plans, and what we've been seeing is our customers are going to those plans as, of course, more data, faster speeds, better coverage has becoming increasingly important.
Andy Penn, always good to have you in the program. We appreciate your time.
Thanks so much, Ross.